welcome back to the UK Crypto Podcast. I'm Paula, and as always, I'm joined by Matty. One of the most common things we see in crypto with beginners and experienced traders alike is portfolios that look exciting but aren't built to survive. People chase upside first and structure second. So today we're going to talk about why crypto portfolios are built backwards very often, what usually goes wrong, and how people can think about structure in a much calmer way. Right, let's get into it.
Before we break that down, we should quickly thank today's video sponsor. This episode is sponsored by Bitchinix. Bitchinix is one of our exchanges of choice. With the link in the description, you're going to get enhanced sign-up and trading bonuses that are exclusive to our community. But by watching this podcast, you can take advantage of those offers. Bonuses vary depending on the current promotion. So if you think this is something that could be for you, there is a link in the description. So let's look at what people usually do wrong when they first build their portfolio.
This is a really interesting one because it brings the question to my mind. Do people think about crypto as a portfolio when they first get involved, or do they just randomly buy some crypto?
I think they usually, rather than randomly, like going eeny, meeny, miny, mo, they're probably getting the very first crypto of the one that grabbed their attention and got them excited.
Yeah.
And that usually involves a hype cycle moment.
Yeah.
Or at least a hype narrative moment. And what I mean by that is nobody's going to buy crypto for the first time when everybody's saying it's scary, everybody's saying it's rubbish, and everybody's saying it's going down. Right? So there's no hype there. There's no excitement.
Yeah.
The first purchase is usually when everyone's going, oh my God, it's amazing. I've made loads of money. XRP, Bitcoin, Ethereum, whatever it'll be. And they'll go, ooh, I'd like a part of that. And then they've got no strategy. They're not looking at any kind of volumes or anything. They're just going, bang, straight in.
Do you think people look at it and go, right, I've got this whatever money and I'm going to build a portfolio? Or do you think they just randomly just buy a coin?
Honestly, I think most people don't start thinking about portfolio structure until they've done a complete cycle.
Okay.
And then once that's out the way and they've got some miles on the clock, they start going,
learnt a few lessons.
Because had I have had a little bit of this, a little bit of that, to do with different types of different cryptos that do different things, have different features and have different volatility, actually that balanced portfolio makes a huge difference. But they don't know about that at the beginning. Nobody does, including me.
Yeah.
I didn't know about a balanced portfolio. I just bought Bitcoin.
Yeah.
Chasing
the upside.
I didn't even know what a portfolio was.
Yeah.
I just bought Bitcoin.
Yeah.
I don't think I'd learned what the word crypto portfolio was for, I don't know, a long time after anyway.
Yeah.
Like it wasn't a thing. I think that's normal, right?
Yeah. Well, I think you were an early adopter of Bitcoin, and there wasn't the alternatives to buy back then. You were buying Bitcoin because it was an alternative way to transact away from centralization.
Yeah.
So I think that brings another element to it. But people getting into crypto over the last decade, there's been more options, hasn't there? But what's your gut instinct? Do you think people buy the big caps? Do you think they see somebody pumping a meme coin? Or
it's different people, different things. So you'll find somebody that'll go all in on one. They'll go XRP, all in.
Yeah.
I don't know, Doge, all in, or whatever, right?
Yeah.
But you have people at the other end of the scale where they will buy loads.
Yeah.
And you'll go, how long have you been into crypto? 6 months. How many different cryptos have you got? No idea. Okay, well, why don't you have a guess? 50, 60?
Wow,
and you'd be like, whoa.
Yeah.
So they're the opposite end of the scale. But again, that's actually just the same kind of thing. There's no plan involved in that, is there? They're just all over it.
Yeah.
So again, I think by the time we finish this episode today, people will have more of an idea of what I consider to be a structured portfolio and why I think that's important.
Yeah, because I think you can buy too many coins too early. I always believe that you should buy projects that you believe in, and it's really difficult to believe that somebody can believe in 50 or 60 projects.
No, that's a scattergun approach.
I think they've all got their advantages, but I think you should buy what you believe in, and I feel like there should be a little bit of some reason why you're buying it, not just because you've seen somebody on social media hyping something. I think that should be like having done a little bit of research yourself and really understand what's behind some of these projects. Because actually, if you talk to the average person, some of them don't know about these projects. They just have heard of the coin.
Yeah, so I had this, and this wasn't even my stream, actually. I was watching somebody else's stream on TikTok, and I realised what the person was doing, and I was a bit like, oh no, it's going to be a car crash, because I could see where they were leading down a path. This person was banging on about a particular what was the token? Might have been ZBEC, I think. the guy said, so the person hosting the stream said, what type of crypto is it? And the guy completely swerved the question because obviously he didn't know.
Right.
And you could see the glint in the eye of the person hosting the stream. And then he waited for a break and he went, what does ZBEC do? The guy was like, I don't know. And he was like, but you've just been telling us for the last 10 minutes how fantastic it is.
Yeah. And
you don't even know what it is.
Yeah.
Like, and it was a cringe moment because I could see it coming as well because obviously I knew, and I was like, oh no.
Yeah.
Like the guy's just been absolutely crucified there. But I think that just highlighted that you can be really passionate about something but have absolutely no idea what it is. And by the way, ZBEC looks like a good project to me. I own a very small amount of ZBEC. So I'm not exactly like a ZBEC like pumping it or anything like that. I've got a very small amount about it, but I get it. So what the point I'm trying to make out of this example is quite often people will be completely passionate about something, yet they don't even know what it is.
Yeah. Yeah.
That research, I think, is important because I think, especially new people in crypto, they don't realize there are different types of crypto that do very, very different jobs. And they all have very different levels of volatility.
Yeah.
And you can use those different levels of volatility to your advantage when it comes to protecting yourself and having a balanced portfolio. Which
diversification.
We'll get onto.
Absolutely. And I think really you've got to think about your portfolio as what's the core of that. And if people are diversified into 50, 60 coins and they've completely evenly spread their investments across those coins, is that diversification? I'm not sure where.
So I don't think there's any hard rule on what it needs to be. Well, we'll talk a little bit about what I think is a good balance, and why I think that. But I don't think there's any hard rule. And as long as you have a method and you've thought about it and you're comfortable with it, that's okay.
Your own strategy.
You don't need to copy anybody. But if you literally have no thought, or maybe you've never even heard about a balanced portfolio, you might be this far into this episode and be going, what on earth is a balanced portfolio? What is he talking about? And that's okay.
And I also think that the other thing to consider is that you've got to think about the timelines and the time horizons because you might have 50 or 60 coins, but doesn't mean that they're all going to work on the same time frames.
No, completely different.
And that's something to consider as well. And I'm a big believer that you shouldn't press buy on anything until you've decided what you're going to do with it and what your exit strategy is, or where you're going to even consider there being an exit strategy. So just randomly buying coins and then thinking that you can probably hold one for as long as you could hold, say, Bitcoin, for instance, that might not be realistic.
Yeah, I mean, I'll give you some examples about that time horizon. So I was watching a speech by somebody from America, and they were the very first person to ever give, to be not a professor, what's it, like a university lecturer?
Yeah, professor.
Is it right? No, professor. Yeah. And they were the very first person in US history to be a lecturer about crypto in the finance world at university level to students. Yeah. So guy knows his stuff. He's literally groundbreaking guy. Yeah. And he was saying, if you look at Bitcoin doing so Bitcoin to reach $500,000. So that at that point, because it had been a 5x. There are other tokens during that time that would do a 20x. Yeah. Okay. So during the same similar kind of time frame, there are some that would way outperform that. Yeah. So that time horizon is really important because if you're looking at doubling your money, quadrupling your money, well, actually being in different tokens would give you different time horizons for achieving those targets.
Exactly.
And I don't think people really think about that long enough about, but the flip side of that is if you have pullbacks, those more volatile ones, well, they'll bleed quicker as well. Yeah. So it's about protecting both ends, the up and the down.
Yeah, exactly. And I think a lot of people just randomly go into buying crypto because they're excited and
that's cool
and that's great, but if it's excitement rather than structure, that's probably something that they need to be looking at.
I should imagine, unless they are an absolute like finance geek, very few people will get into crypto with the structure at the beginning. I'm sure there'll be probably somebody going, well, I did. Well, brilliant. What's your background? They're probably into economics. They're probably into finance. They probably come from a household that's deep in that already. So, for instance, our son, I'm going to try and be teaching him structure from day one. Yeah. How many teenagers are going to be getting that? Very few, I should imagine. They're going to get into crypto, the younger generation, because of a hype cycle, because of something exciting on TikTok or Insta or whatever it will be. They're going to be the minority. Most people, excitement in.
Yeah, 100%. And I think probably just before we move on to crypto portfolios, it's probably worth saying that when we talk about diversification can't just be buying different cryptos. And we need to think responsibly. Crypto is the riskiest of risk assets. I still heavily believe that we need to have our investments in different places, because when markets all move at the same time, we've seen it over the last couple of weeks, gold moved at the same as the stocks moved at the same as the crypto moved at the same. But if you had all of your money in those three, you'd be really, really worried at the moment because they all dropped at the same time. But if you had cash, if you had ISAs, if you had property, you would be feeling like you had more a more balanced portfolio, because not everything's riding on that. So I think just probably as a bit of an interject, we talk about crypto all the time, but I think crypto still has to be a part of a wider investment portfolio.
Absolutely. Whether it's property, whether it's just straight out savings, whether it's ISAs, whether it's stocks and shares, whether it's physical metals like gold and silver. I think having that diversification is always a good thing. Just like I don't think it's good to be all in on one crypto token. I don't think it's good to be just in on crypto either. But there again, it can be down to people's affordability. Some people might just be starting out in investing, so they've got to start somewhere. So I get why they might pick crypto first, especially in today's world. But again, as your wealth grows, I think diversification out of crypto into other things as well is a smart move.
Absolutely. Because we always talk about staying in the game, and to stay in the game, you've got to keep your capital, and having all of your capital in high risk assets, you've got more chance of losing that money and then being out of the game. So
that leads us into the common problems, doesn't it? That leads us right into the common problems. I mean, that high volatility stress is a big problem for people.
Definitely.
So again, if you are the kind of person that's going to feel that kind of stress, do you really need to be trading meme coins? I'd say no. Do you really need to be trading anything outside of the top 10, 20? Probably not. Because that high volatility could cripple you.
Yeah, absolutely. And let's face it, Matt, even if you're buying Bitcoin, which is considered the least risky of all the cryptos, if you had bought Bitcoin in August 2025 at $125 and you're now looking at it at the moment, and what was it, $80,000 the other week, that's a big drop, isn't it? So I think it is going to be scary in those moments, because even the safest cryptos have got huge amounts of volatility.
But that's normal, that's crypto.
Yeah, I know.
This is the thing, it's normal.
Yeah.
Like that kind of pullback it happens all the time. So I did a thing inside in the crypto wolf pack where we looked at every single bear market and we measured from the peak to the bottom, and it was regularly, I mean, the smallest one was 45% pullback and the biggest one was 80% pullback, and that repeats every 4 years. Well, I believe the cycles are dead now, but listen, going in historically, that's completely normal. So we're now currently in the middle of a completely normal structured pullback. But if you're new to it, that's going to be like, boom, blow your head off. Like
Exactly.
Which is why people need to look at those time horizons. It's really important.
Exactly, because else you're just constantly second guessing yourself, aren't you? You're constantly second guessing the decisions you've made, and then when you are not comfortable with those decisions, if you've put your entire life savings on that, that's a lot of pressure.
Then if they've got an unbalanced portfolio and things don't go in the right direction, they'll try and overtrade to fix it. Another common problem. Overtrading, I think, it can be a big problem for some people.
Because, and also I think you see a lot of people on social media, and it's definitely within the strategies that we teach in the Wolfpack, is to DCA in, so dollar cost average when the prices are going down or when the prices are going up, to buying crypto incrementally. That's really good. I think that's actually a really good approach, as long as you can afford it. If you're pressurizing yourself, that you're thinking, oh my God, this is at the bottom, we're in extreme fear, I need to buy some more crypto, but actually you're using money that should be for rent or should be for
but you could
bills.
adjust that amount to fit your circumstances. I mean, I don't know if people get paid weekly, monthly, whatever it is. Instead of going, I commit to buying, I'm not going to put a figure on it because different people's pockets have different depths, right? Whatever the figure is you've just imagined in your brain by people watching this now, right? You don't have to commit to that every month. Instead, you could be going, well, I'm going to do my calculation to see what I feel comfortable with at the end of every month. That's still a DCA. It doesn't have to be the same figure. Just to be for clarity, I'm DCAing in currently into Bitcoin, XRP and Ethereum. One of them, I'm doing exactly the same amount of a purchase every single day. The Bitcoin one, I'm doing as and when. So again, they're both DCAs, but one's got hard structure. It's the exact same pound amount a day.
Yeah.
And another one is as and when I've banked cash and then I'm going to buy in chunks. So you can do that to fit whatever you want. It doesn't have to be the same. I think a lot of people think DCA has to be rigid. You must buy X amount a week, X amount a month. Not at all. You can DCA in at whatever rate you feel comfortable with.
Absolutely.
And in fact, I'd probably encourage that until you've got enough of a slush fund. That's probably the sensible thing to do.
Yeah,
anyway.
absolutely. And then, I mean, people overtrade to try and fix it and then sell at the wrong times, because there's a lot of people that are worried and just go, as soon as it's in the green, I'm out.
But again, it's because your portfolio's unbalanced.
Yeah.
If you had a portfolio that was balanced, when we have the pullbacks, it wouldn't feel as bad.
Yeah.
And we'll explain why in a moment.
Yeah.
So we might watch it going, what on earth are you talking about?
Yeah.
We'll explain. It'll make sense in a moment.
Yeah. And that emotional resilience that you need to be holding through pullbacks and through these cycles. I think it's a time thing. I think you got to be in the cycles. I think you got to feel how it feels in those moments, because ultimately, as long as your portfolio isn't overstretching you, yes, it can feel uncomfortable, but actually, it's not the end of the world.
But all these things that we just mentioned there usually happen because they've missed the crucial steps at the beginning.
Yeah.
And the first one is they've got no base layer. This one is really popular at the moment. Popular is the wrong word. This is a common mistake I'm seeing right now.
Yeah.
So I will talk to people and I'll be like, how long have you been into crypto? A year, 18 months. Brilliant. What have you got? And they'll go, XRP. Anything else? No, I've got XRP. Okay, cool. How much XRP have you got? And then it'll be a big amount.
Yeah.
And I'm like, okay. So they'll be like, yeah, I've got that because actually I believe over time it's going to do more of a multiplier than Bitcoin. And that's quite a common thing I hear, right? What they're missing is they have no base layer to their portfolio. They are betting a one horse, right? On a one horse, right? And it ain't a one horse race,
Yeah.
right? So with a single purchase of a crypto, like that for example, when we have a pullback, because XRP is not in that top category of safe cryptos, most people will assume it is because it's one of the larger caps. It's not. It's more volatile than the top ones. Yeah. So if you look at a Bitcoin or Ethereum, they're way less volatile. Now, Ethereum is going through a dodgy month, right?
Yeah.
But apart from this dodgy month, we don't normally see it being as volatile. So when you look at a base layer for me is very simple. It is two cryptos. It is Bitcoin and it is Ethereum. They are your bankers, okay? And when it comes to a portfolio, for me, your base layer should be about 50% of your portfolio.
Okay.
Now, I often use this phrase. I'm going to say it again. I'm nobody's financial advisor, and I'm not your dad. Well, we could say that to our son. Okay, I'll have to adjust that when I tell him about the base layer. But for anybody that's not my son, I'm not your dad. You don't have to listen to exactly what I'm saying. I'm just telling you what I do. And it's worked for many years.
Yeah.
That base layer is so important because during the volatility times, they're less volatile, and it's gonna soften your overall portfolio when you have a pullback. And before anybody says it in the comments, but the more volatile ones, when you go up, means you're gonna make more money the other side. It does. But what we're protecting here is your portfolio during the shit.
Yeah, because 50% of your wealth is going to be in something that's more stable.
During the good times, you'd be better to put every single penny into a meme coin that's going to win. But who on earth is going to do that?
Yeah.
Because it's too risky.
Yeah.
So this is about risk management. So Bitcoin, Ethereum, base layer, 50% of your portfolio, in my opinion.
Well, it's interesting you were saying about Ethereum having a dodgy month, because I actually watched somebody do a little bit of chart analysis the other day, and they were looking at the monthly Ethereum chart, and they said, really, for it to still be following the trend, it could pull back all the way to $1,500, which is a huge pullback, and it feels like that. But I think it could pull
but if
all the way
Ethereum
back.
pulls back to there, you'll see XRP at 20, 25 cents, 30 cents.
Yeah, exactly.
And believe me, it can happen.
Exactly.
I know people don't want to hear me to say that.
Yeah.
Because there's a lot of the XRP community that follow us, right? They don't want to hear it, but it's true.
Yeah, exactly.
It's true.
Exactly. But it's still one of the... Traditionally, people bought into Bitcoin, they rotated into Ethereum, and then it went the rotation from everything else from there, didn't it?
I've had a guy recently telling me that his biggest holding is a meme coin that he bought from a project.
Wow.
I'm like, how much money? He said, I'm like, well, okay, fair enough. Wow. But again, completely unbalanced portfolio, completely unbalanced to its max.
Yeah.
Very, very difficult.
Yeah.
But again, nobody knows about balanced portfolios until they don't know.
Exactly. And I think that yes, people are missing this base layer, but they're also missing why the base layer is so important from risk awareness perspectives, because we can't have all of our investments in high risk assets unless your risk appetite is really, really, really high. And that's not
unless you're minted.
People.
Okay, so if you're going to go and put, I don't know, should we make a figure up? 20 grand, right, into a high risk, low cap coin, yeah? Well, that's okay if your wealth is significant enough that you won't even notice that.
Yeah, and that's okay. But I think even people that are minted, well, they're going to have other things in their portfolio.
Exactly.
It's very unlikely that they're going to be putting all their eggs in one basket.
Yeah. 100%, which is why that base layer is important.
Yeah.
Because it softens the swings.
Yeah.
Yes, you're not going to get the pumps the other side either, or quite as big as if you'd have been in some of the more volatile stuff, because the pumps will be harder.
Yeah.
But it will also soften the blow on the way down.
And I think also about the sizing of the amount that you're holding in each of these coins as well is really important.
Well, we can do the sizing. I mean, once we explain about the different sections, we can talk about the sizing in terms of percentages.
Yeah.
So should we quickly rattle through there? So we've done the base layer. Should we explain the other layers? You okay to do that now?
Of course.
I know it's a bit out of sync to what we were going to talk about, but are you okay if we do that now?
Sure.
So the base layer is the big boys. That's your Bitcoin and Ethereum. Now, below that layer, this is where we're talking about things that have got utility. So cryptos that physically can do something. Yeah. An XRP, for it as an example. The reason I mention that is because it's probably the most popular token out there that does something.
Yeah, with utility. Yeah.
Solana.
Yeah.
Again, monster project.
Yeah.
Does something.
Yeah.
Has a usage.
Yeah.
XLM, another one. Slightly down the rankings compared to the other two, but huge amounts of utility.
H-bar.
Yeah, and a H-bar, another one, right? All these fit into a category of cryptos that do something rather than just being a crypto, For me, those have a place. I'm going to be calling them now my layer 2, So the second rung down. Now, in terms of percentages of your portfolio, I think you should be looking around 30% of your overall portfolio inside those layer 2s.
Yeah.
That doesn't mean 30% on one, hedging your bets a little bit. Yeah. Does that make sense?
Yeah.
So then your layer below that is your more risky assets. You're thinking about things that are a lower market cap, that are much more volatile.
Yeah.
Now, in those ones, just to explain this actually, because some people are going to watch this and the ones that we name, they're going to go, they're not very risky. That's because I'm not very risky with the projects I back. Very occasionally, I'll go and back a really, really risky project with a tiny amount of money.
Yeah.
I ain't even classing that as inside my portfolio.
Yeah.
They are just random things that I'm taking a little punt on. For me, that's like going to the bookies on a Saturday and going, I'm going to do an accumulator on the footy on some scores. That's how I look at that. Yeah, that makes sense. It's not even in my portfolio. I don't even class it as in my portfolio.
Yeah.
I'm talking about your structured crypto holdings.
Yeah.
The next layer here is things that are more volatile, so that when you do get those swings up, you're going to benefit greatly.
Yeah.
But when you do have the swings down, because it's a much smaller percentage of your overall portfolio, it's not going to devastate you. Yeah. And for those ones there, we're looking around 15% of your overall portfolio. An example of some of them tokens for me are going to be some of the big boy meme coins. In fact, they're so big, I don't think we should even call them meme coins anymore, because they're just massive. I mean, if you look at Doge, Doge is a meme coin.
Yeah.
It has an ETF at the stock exchange.
Yeah.
Crazy.
Yeah.
Just ridiculous to me. I'm still not over it. And I mentioned it about 3 times in different podcasts because I can't get my head around the fact there is a Doge ETF in the stock exchange in New York.
Wild.
Doesn't make sense. But yeah, we're talking about Doge, Pepe, SHIB.
Yeah.
Anything around there where it does have those swings. A lot of them are still big caps compared to the category they're from, but they're not part of the major players where they've got usage.
Yeah.
Interestingly, we might have some crossover there, because what happens when one of those big boys gets some usage?
I know, yeah.
What happens if X suddenly go, all X payments are done on Doge? We've got a hybrid token.
Yeah.
We've got one that's going to fit in multiple categories here. But that's the future, isn't it? So yeah, we're looking about 15%. And then the final category that you need to be putting your money into is cash. Cash is a position.
Yeah.
No matter what anybody's telling you now, cash is a position. And that final percentage that's left, you need to be looking at cash. And the reason for that is that you can take advantage of the market during times where the opportunity arrives. So we've got things like pullbacks, haven't we?
Yeah.
When those pullbacks happen, it's really important that you have some cash on the side to be able to do something with it to take advantage.
Yeah.
Does that make sense?
100%. 100%. So 50% in the big boys, so Bitcoin, Ethereum, 30% in the utility coins, things like XRP, HBAR, XLM, that kind of project. Then 15%,
and then 5% in cash.
and then 5%. Awesome.
Yeah, and hopefully that's made sense. Hopefully that made sense because we've got the largest chunk in the safest of those assets.
Yeah.
Listen, no crypto is safe. Let me get that over there now. But in terms of crypto terms, the safest, the big boys.
Yeah.
The next chunk down, slightly lower percentage than the top one.
Yeah.
Slightly more risky. And these guys have utility.
Yeah.
Below that, we're looking at stuff where they're still powerful, but they have no utility.
Yeah.
So these things could drop to zero overnight.
Yeah.
But also during a pump, they're going to go crazy.
Yeah.
Because they're sentiment driven.
Yeah.
Then the bottom one is a bit of cash.
Yeah.
Cash is a position. People do not listen to me when I tell them that. Without cash, you're now just on a hope and a prayer.
Yeah.
You need to bank cash as
Yeah.
well. Yeah?
Yeah.
Make sense?
100%. 100%. I guess that it looks very different person to person because we can outline what we think it should be, but people do have different risk tolerances, don't they?
Yeah, for sure. And I think that's also healthy. If everybody was exactly the same, everybody would back the same tokens at the same time and there'd be no market.
Yeah, exactly.
You need these different opinions and all that shit to flood, which is why when I'm giving my opinion here, I'm not saying to you like mine's like, I'm not, it's like the 10 commandments, you must follow this. Absolutely not. I'm just saying this is my strategy and it works.
Yeah.
You need to look at what I'm doing, but rather than looking at the exact percentages of what I'm doing and copying them, understand the reasons of why I'm saying those percentages.
Exactly.
Because if you can get your head around the understanding and the reasoning, maybe you can tweak it to fit your risk. You might take more risks than me, and that's cool, you know.
Yeah.
Just because I'm saying the most risky I want to get is Doge, Pepe, and SHIB, for example.
Yeah.
Doesn't mean that you can't go lower down the market caps.
Yeah.
As long as you understand that you're making a calculated decision and why you're making them, rather than randomly seeing a video on social media where somebody says, token Gingerbeard is fantastic, go and stick 100 grand in it.
Yeah.
That's wild to me.
Yeah.
That's wild
to me. Yeah, and
I
I think probably what you're saying is that actually look at what you've got and how risky each one is and then how much of your holdings
assess
are
yourself.
in it. Yeah.
Assess yourself.
Yeah.
I tell you what I wouldn't mind doing one day, and it might be, we've got a lot on our plates at the moment, a lot of projects. I wouldn't mind making like some kind of a little app or some kind of a system where people could answer some questions to see how risk averse they are.
Yeah.
And it builds them a structure.
Yeah.
Not tell you what to buy. That's wild, because I'm not here to tell people what to buy.
Yeah.
But giving them categories and percentages, just depending on how risky they are.
Yeah.
I think there'll be a lot of people, maybe just build that for our community, you know?
Yeah, that would be awesome.
Yeah, I don't think it'd be that too difficult
But
to
I
do
think,
that.
and we touched on this earlier, but just because you've got a portfolio doesn't mean that all of them have to work in the same time horizons. So you don't have to buy everything and hold it for the exact same length of time.
No.
And then also different people are going to have different aspirations for how long they want to hold their crypto before they start taking money out of it as well. Because, I mean, some people want the short-term fix with crypto, don't they? And they want to make money in the next few months, and then other people are buying crypto and then the plan is
then you need to go more volatile
to hold it,
but then you need to go more volatile but then you also need to take it on the chin if the market flips and that volatility makes you lose money. But you've got to understand the risk.
I also see people very often just say, I'm just going to hold. Well, what does that mean?
Yeah,
like,
you often say this, but I think it's okay if people are going to say, "Oh, mind you, you've answered this before." When I've said about 10 years, 20, whatever, it doesn't. I think that's okay to hold, but you need maybe we can do for retirement.
Yeah,
we've got somebody in the community right now. He literally wants to retire.
Yeah,
that's okay.
But do we hold it for retirement, or do we hold it to sell approximately in those amount of years when the cycle's at the right part? Do you know what I mean? I think having a time frame is great. I think obviously the longer your time frame is, the more chance that's going to be successful, because if we historically went back on crypto prices, they have gone up from inception to now. So long term, I think that's great. But I also think it's okay to say when we hit the next extreme greed, I'm going to sell X, Y, and Z. I think that's okay.
Yeah, for sure.
I think it's okay to go, I'm not going to try and time the top, but this is kind of the time that I'm looking at reassessing. And I think just just buying and holding, sounds like a great idea, but I think you need something just a bit more thought to it than that.
Yeah, no, I totally agree with that. I think we've also got people who've got different emotional limits.
Yeah.
So this is being highlighted in the part of the market right now. As we're recording this video, the market is in the middle of a pullback. Things are really scary.
Yeah.
Some people are really struggling. Well, if you had a balanced portfolio, maybe that would have helped you out a little bit, right? Now, there will be some people in the middle of this pullback, and this is going to be like water for ducks back, and actually, they're going to learn something that's about themselves very, very important right now, which is they can handle it.
Yeah.
Right? If you're in the middle of this scary zone and you're going, I'm seeing everybody's heads fall off, but mine's not. Why am I not falling off? And you're going, okay, let's have a look. And actually, their portfolios are very similar to other people's, but their head isn't falling off. That tells you something very important about that person. They can handle. They're resilient, right? And for whatever,
they haven't overstretched themselves.
Yeah, I mean, it could well be they're just better at controlling their emotions, right? And if that is the case, then maybe they can handle slightly more volatility than the next person whose head has exploded. Very, very quickly. So yeah, I think that learning your volatility level of where you put yourself to be uncomfortable. Personally, I think it's okay to feel uncomfortable. It's about how you handle that feeling of being uncomfortable.
Yeah, absolutely. If it's going to take over your life, then it's actually not proactive, is it? And maybe if it is taking over your emotions in that way, then maybe tweaking how risky your portfolio is, it wouldn't be a bad idea either. Because maybe you just are a little bit over. Your risk appetite is a bit too high, or your risk appetite is not high enough for the portfolio you've got.
Who do you think's got a bigger risk appetite, me or you?
You.
For sure.
Yeah.
You trade Pepe.
I love Pepe.
Exactly. Because we always say this, and I was thinking about this today, because I actually didn't make the video in the end, because I couldn't quite nail down the direction of it, but I nearly put this into a video. That people would always say that I'm more, in fact, tell people that, yeah? Mm-hmm. You trade Pepe, mate.
I do trade Pepe.
On a regular.
So
let's just clarify, for anybody that's relatively new to crypto, I've just put Pepe in my riskiest pot.
Yeah.
And Paula trades that daily.
So, but I want to probably give people some perspective. I don't only trade Pepe.
True.
And I don't put my entire amount of my available leverage fund part on a trade. So for me, yes, I am trading a more volatile asset, and I'm going to tell you why. Do you know why?
No, go for it. I've got an idea, but go on.
So I think it's my probably weird brain, but I like watching the Pepe chart on the 1 minute chart because it looks weird, and I have watched that chart for hours and hours and hours and hours and hours, and none of the other crypto charts that I've seen look like that one.
Other women watch things like Sex in the City, Coronation Street, Emmerdale, and you're saying you sit there for hours watching the Pepe chart. Yeah.
I don't care.
That's fine. Look, mate, I'm a big believer in it. I'm just saying, are you aware that us crypto people are not normal?
Yes, 100%.
Yeah, I respect it.
100%. But yeah, I like Pepe, and I like the volatility. I think it makes it fun to trade. But do I risk my entire trading part on that? No, I don't. And I trade low leverage.
Yeah.
And I manage my risk in that way because I also, for me and my personal situation in terms of funds, my leverage trading part is not the biggest part of my portfolio.
No, it shouldn't be. But so many. You bring on to something quite interesting there.
Yeah.
How many people, when you'll delve down, if they're open enough to talk to you about numbers, and you'll say, how big's your thingy pot? And they'll say X, Y, Z. How big's your spot holding X, Y, Z? And it's pretty even.
Yeah.
And I'm like, whoa.
But I like to trade a part of my pot. I like to be able to leave myself enough of a slush that if I decided that I wanted to add more funds into my trade because my trade might be going the wrong way, I've got a buffer of doing that. And I don't anticipate, although Pepe is more volatile than some of the coins, I don't really ever put on a trade to think that I'm going to be closing it in the next few minutes, hours or days really, because they're always more long-term trades. So there is a bit more volatility, but I'm not expecting to take huge profits out of my trading, and maybe I just trade in a different way to some people. I'm not sitting there waiting for it to go to 100, 200, 300, 400% up because I don't feel like on a low leverage that's achievable, and I think a lot of people don't close their trades early enough and then end up missing the bit. So I would rather.
You mean like me with my chest?
Yeah, like you with your chest.
I had it 85% up on a 3x.
Yeah, and you didn't.
I let it go all the way back down.
Yeah.
Because I was trying to prove a point.
Yeah.
Ego got in the way on that trade.
Yeah. I would rather make 20 or 30% on every single trade than have them liquidated.
Yeah,
that doesn't
absolutely
make
no doubt.
sense to me.
So just, for anybody watching this now, I didn't follow my own strategy on that trade. For that chess trade, I was using my own strategy. I should have been taking profits at about 30, 40, 50%, partial closing it, moving stop loss above break even, and then moving on. But I was trying to prove a point about this trade. So my ego got in the way because I thought, oh, you know what, this could be a killer here. Yeah. And actually, by abandoning my own strategy, market dropped. I think it's probably about 50% down or something, 60, maybe higher than that now. So again, this is why strategy is important, right?
Yeah, exactly. So I think that you can negate some of your risk in the strategies that you're using. But when we're talking about building a portfolio, we're actually talking really about spot holdings.
Yeah, for sure.
But yeah, we went a bit off topic, but I think when you are leverage trading, you need to think about your strategies again. If you're trading coins that are more volatile, or how do you negate the risk that you're taking if your risk appetite isn't as high, which is why you have different leverages. It's why you have different approaches, and also it's why you should be taking profits on the way in. It's why you should be adding. Very often you see the big institutions when they're adding onto leverage trades, they don't put everything in one trade. They don't put everything on at the same time. They will go into their trade in stages, and there is absolutely nothing wrong with that. So don't just press a button. Just think about it before you do that. I think that's the important thing.
But I think when we're talking about the portfolios and making them simpler, I think that's really important. Obviously, when we've been talking about all these things that go into it, so like people's time horizons, their different tolerances, this is where simplicity often wins, especially when we're talking about that structure of that portfolio.
Yeah, absolutely. Because it will allow you to make fewer decisions. If you've got a portfolio that's balanced, that you know what you're going to do, you know the entry points that you're looking for to add more if you want to, or you've decided on an amount that you're going to DCA in, you've decided which percentages you're going to hold in which assets, you actually have less decisions to make, don't you?
Yeah, and I think there's something to be said. And again, this is a side of crypto where I don't think enough people talk about it, including us, right? And I think maybe the podcast is a perfect platform to talk about this, which is to say that having clear convictions with a plan actually has huge benefits for people's mindset. Yeah. Or I know today's buzzword in 2026 is more about like mental well-being, that type of thing. Well, it's probably a bit too fluffy for my language, that kind of language, but for your mindset in particular, because if you're doing it with clear convictions and you're certain about a structure and you're comfortable with it, you're going to be worried less that you've got it wrong. Yeah. Now, if you are a scattergun approach, you'll know you've done that. Yeah. Even if you're not telling anybody, you're a trading genius, you'll know deep in your heart that you did that. So when it starts going the wrong way, you will not only question the market, you'll question yourself, you'll question your decisions, blah, 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 and it will snowball. Yeah. So having those clear convictions at the beginning with the structure, I believe, doesn't just improve your portfolio, it improves your mindset because you can be comfortable with the decisions that you made. And
it helps you to manage your risk easier because if you have got a balanced portfolio and you've decided on what percentage you want, in what risk assets you want, actually that management of risk becomes easier because you've got your chunks in each place and you don't have to worry quite so much that you've put all your eggs in one basket or you're waiting for this particular token to moon.
Yeah, and then you don't have to, you got less noise.
Yeah.
Because if you are literally waiting for a token to moon, you could be waiting till never.
Yeah, exactly. And you're going to be more consistent because you have not put all of your money on more volatile assets. And we know there's no consistency in those volatile coins.
No.
Look at the average meme coin.
But I like that volatility. I like it. But if your portfolio is not structured, that's what's going to kill you.
Yeah.
That's going to kill you, isn't it? But that volatility is fun, man. That's how we make our money. Let's get it straight. But it goes the wrong way and you're not balanced. It's going to crucify you.
It's going to crucify. That is not consistent. And this ties into something we say a lot. Most people overcomplicate their portfolios early on in their journey.
Absolutely. I mean, experience leads to simplified portfolios.
Yeah.
It does. It does. So I tell you what's quite interesting. So there's one of the moderators in the Wolfpack. He likes to pull up whale watching wallets. So
Whale watching wallets.
So I try to say that again. Whale watching wallets. So he likes to look at the crypto whales.
Yeah.
Why am I saying whales like that? Crypto whales.
Whales.
So I don't know why I'm talking like that. But yeah, he'll pull up He'll pull up I can't say it. He'll pull up the crypto whales and their movements, and quite often we'll go and track those wallets and go and look at them.
Yeah.
There ain't nothing complex about it, man. Bitcoin, Ethereum, XRP. Yeah, you can see it, and then you'll see when you get the random tokens, it's tiny amounts compared to the big boys. There's structure to them wallets.
It was interesting because on one of the live streams we did in the Wolfpack, the moderator had shared some of these, and then we clicked onto the wallets. I don't know if you remember.
I was there,
and it was really interesting to have a look at some of these really big wallets and see how diversified.
Do you remember that one that had $8 million worth of Ethereum? I think it was like $50 million of Bitcoin. Then they had $90 of Doge. No, it was $90 of
Badger.
$90 and we were like, the guy has got, I mean, whatever it was, I don't remember what it was, I don't know, 8, 60, 70, whatever it was in the wallet. And he had a random $90 purchase of Badger. And we were like, who's doing that? Like, what happened? And we think, surely he must have had a massive amount of Badger and sold it. Oh, no. That guy transferred in around $80 and it just gone up to 90. Like, he's going, lovely, made some money on that. And we're talking to somebody that got millions. Crazy. I mean, that's probably the best balanced portfolio I've ever seen. I mean, he's gone, I'm not being risky here. I know I'm worth 70, 80 million or whatever it was, but there's no way I'm doing more than $100 on Badger. Way too risky for me. Funny. It just makes you realise even the big boys like a little punt every now and again.
Absolutely.
Funny.
Absolutely. And I think it's also important to know that if you're sitting there currently and you're looking at your wallet and you've got 60 different coins and you're thinking, I am definitely that person that they're talking about, there is nothing wrong with deciding what you're going to do with each one of these coins and then start balancing your portfolio better.
I think let's talk about this because maybe me and you might have a different opinion on this. And it's cool. So let's say someone's watching this now and they're going, you know what, I ain't got a balanced portfolio and I own loads of just random stuff. Mm-hmm. What's the best plan? I'll tell you what I think. You can either agree or then give me your opinion, whichever you think, right? I think, honestly, don't panic, because especially as the point of recording this, we're currently the market's in a pullback. I'm a big believer in not selling cryptos in a loss unless there's an absolute disaster, right? I would wait until the market's sentiment's flipped in a month, 2 months, 6 months, a year, whatever it is, and take that position. And let's say we get up to extreme greed, all-time highs, that type of thing. Cleanse your portfolio. Cash out on some of that crap.
I know.
And then
I agree.
when the market drops back down, rebuild again with a little bit more structure. And then it's a bit more of a big boy portfolio then, rather than just random stuff.
Yeah, I agree. I think if you have got money that is spare, that you are happy to invest in crypto at the moment, whilst we're in extreme fear, it's a great time to add to your portfolio. And adding to it now, but thinking about how you can do that to make your portfolio more balanced is great. I wouldn't suggest that you just go and try and flog off all your coins unless they're in the green. But I mean, personally, I would wait until that sentiment has flipped. Wait until we're in greed or extreme greed, because we know that these cycles go up and down and we will get there again. So potentially my advice, if I was going to give any, would be DCA in if you can, whilst we're in extreme
to
fear.
build up the base layers and the important layers.
Build up your base layers. Don't feel like you've got to wait till the next cycle of this. If you've got the money to do it.
Now's a brilliant time.
Yeah,
we're in the middle of a pullback.
If you've got the money to do it, then do it now. If you haven't, don't stress yourself. I wouldn't be selling crypto at a loss. Just wait, just hold it. However, if you have invested in meme coins, I would suggest you just keep a really close eye on them because they move so fast. You might not need to wait for quite so long until we're in extreme greed because they go up and down so quickly. So you might see that actually it's gone up, and then you can get rid of those at a time where it's in more profit.
Oh, yeah, absolutely. I mean, on top of that, I think we need to just remind people that survival is more important than anything else. Like protecting your capital, not entering into losses, not losing trades. It's more important actually than the balanced portfolio if you're already in that position already. But your time's right. Hopefully some of this information has helped people think about that.
Yeah, because you don't need to catch everything.
Nah.
You don't, like, I think a lot of people put a lot of stress on themselves. Crypto is 24/7. You can't catch every single move, and that's okay. Like, there'll be other moves. There'll be other entries. There'll be other times to buy. And if you're holding spot and you're DCAing in, it doesn't really matter.
Yeah,
anyway.
absolutely. I mean, the real goal here, let's be honest, is staying in the game long enough to make money.
Yeah.
Because most people will get shook out. They get shook out at the wrong end of the market. They're out. And then when it booms the other end, they'll FOMO back in. They'll FOMO back in at higher prices. And then it's counterproductive.
Yeah, absolutely. So what's our takeaway here, Matt?
I think strong portfolios are built to survive first, in my opinion.
Yeah.
I'm seeing it now. Some of the people that heads are falling off is because they've got unbalanced portfolios. Yeah. So we need to see if we can get that message through. But again, I'm not your dad. Yeah. I'm not your financial advisor. Just telling you what works for me.
Yeah, because upside is second.
Exactly, because protecting your capital first, then you can start thinking about making profits.
Yeah.
And this one's not going to be popular, okay? But it's true. Structure beats excitement every time.
Yeah.
So I get it. If you're going to go and dabble down the bottom end of the market and you know damn well you can make loads of money real fast if it goes in the right direction, brilliant. But if it goes in the wrong direction, you've now lost loads of money real fast as well. So that structure beats the excitement for me every day. Still have a dabble down there if that's your thing.
Yeah.
But get the structure right first. Make
100%.
it safe.
100%. I think that's a great way to end our episode today. Thank you so much, Matty, for joining me again. And guys, let me know in the comments, has this helped? Is it something that you've been thinking about before? Have a look at your portfolios. Where is your risk? Where's your risk appetite?
Let us know in the comments. Do you think your portfolio is balanced?
Yeah.
Or do you have an imbalanced portfolio?
Yeah.
I'll be interested to see what people are saying. I would imagine if people are honest in the comments, you'll see more people saying unbalanced.
Yeah.
Than balanced.
Yeah, I really hope this information helps. As always, if you're watching us on YouTube, click on the link below, subscribe to the channel. And if you're watching on Spotify, follow us on there as well.
And don't forget, there is a link in the description to get their Bitchinix exclusive bonuses for trading and sign up. Appreciate every single one of you for watching. Please remember to subscribe and we'll see you on the next one. Remember, 7 p.m. UK time every single Friday.